The vast majority of your training on this program revolves around conducting quality fundamental analysis and understanding what type of impact specific market events are most likely to have on the related currencies. A lot of people join our program after being trained heavily in the arts of technical analysis with the perception that fundamentals are difficult to understand or hard to grasp. The trading strategy that we're going to look at in this video is definitely more technically focused, quite simply because it's designed for times when there is nothing fundamentally happening. This is a short-term strategy and something that could be identified most closely with the style known by many retail traders as scalping. The reason we included this here is because some professional traders do take technical levels into consideration, and if you spend any time watching them, you will notice how effective they can be as the price reacts and bounces off them time and again. The trick to making money from these bounces, though, is in having a thorough understanding of what is happening fundamentally first and foremost, because it is this that drives the prices over anything else. So what do we mean by technical bounces? The concept is very simple to understand and consists of the price hitting certain levels, at which point the price move reverses and the price bounces off the level in question. The reason that these bounces occur is that the levels are usually places where a lot of traders have orders waiting to be entered as soon as the price reaches them. When the price gets there, the sheer volume of orders being triggered is enough to temporarily cause the current direction in the price to be reversed. Understanding what constitutes a tradable level is of course pretty important. But before we get into that, the most important part is to make sure there is nothing going on or even coming up fundamentally to put our trades at risk. An example of the best time to trade this style of strategy is during the Asian session, when there is light volume and there are no upcoming risk events on the calendar that could start generating volatility. As a final precaution, it's always very wise to have the audio squawk on in the background so that if there's anything that does happen unexpectedly, you'll be alerted immediately and can take action to protect your positions or even change your style and take advantage of incoming news. The latter is how a professional trader at a firm would act, and it's also the most profitable manner in which to approach the markets. So assuming you have all of the fundamental analysis in place and you're happy that there won't be too much volatility on the pair you want to use, the next step is to start looking for these key levels to trade. This brings us back to the question of what a key level is and how do we know whether or not there will be a bounce from it. Identifying key levels is relatively simple, and we'll begin with price levels that have recently generated a bounce. It doesn't matter which way the bounce happened. For example, the price may have fallen into a level and bounced up, or risen into a level and bounced back down. The main thing is that there was a clear reaction that you can see when looking at a price chart. These types of levels are good because the market has already proven that it paid attention to it once. So it's a good chance of getting a similar reaction the next time. Very solid examples of recent levels are the high or low of the previous trading session. These can be very significant levels. Another type of key level is something known as psychological levels. These levels include price numbers that the market's human brain may naturally find significant and use as a reference point for placing its orders. Very common psychological levels are any price with a double zero on the end, such as 132.00 or 156.00, and also 50 levels such as 132.50 or 156.50 and so on. After some brief analysis of possible levels, you'll notice that a lot of them, and it's very difficult to pick the best one to trade from. Trading them all isn't practical, so you need some kind of filter system to pick out the best levels. The way that professional traders filter these type of levels is by looking for the ones that have more than one reason to trade from them. We call this a confluence of events. And this basically just means that more than one thing is at a specific level. Looking for confluences brings us to our next set of levels. And these are things that can be used as confirmers for recent levels that we have just covered. A confirmer is something new that wasn't there before, but that now lines up very well with an old psychological level or previous reaction point. Confirmers can include things like daily pivot points and Fibonacci retracement levels. If you are not familiar with these things, then it's definitely worth doing some extra research, because although they are purely technical concepts, the fact that so many traders watch them can make them significant. A lot of retail traders will get drawn into these types of concepts because they appear so simple and easy to trade. The drawback is that if you simply go away and try and trade straight off a pivot point or Fibonacci level, then you will soon get frustrated because alone they can be quite inconsistent. So what do? Remember, these two things and any other purely technical tool should only be used in conjunction with other concepts. Otherwise, you'll get frustrated and feel like giving up. So let's take a quick look at both of these tools in more detail, starting with Fibonacci. This tool is based on a mathematical formula discovered by Leonardo Fibonacci hundreds of years ago. And the interesting thing is, this formula is consistent throughout nature and the universe. Part of the formula is based on certain ratios. These ratios measure the distance between 2 points. For example, in nature, it could be the distance between the branches on a tree, or in the universe, it could be the distance between galaxies. These Fibonacci ratios occur in a surprising and unrelated number of things in the real world, which of course has led to great fascination. Traders gravitated towards this concept because Fibonacci ratios are also found in elements of human behaviour. So of course the gurus and educators looking for ways to simplify trading took the concept of Fibonacci, generalised it a lot into specific numbers. They then created a tool that could display these numbers onto a price chart as places where human behaviour would supposedly draw people in and encourage them to trade from. So the final result was the Fibonacci retracement tool. The tool is drawn onto a price chart and then it displays a few different levels called retracement levels. They are called retracement levels because when the price moves in one direction, it normally stops and then reverses back in the opposite direction. This happens when traders are taking their profits and there is a temporary oversupply of buyers or sellers. But the fundamental move hasn't changed and the market is still looking to trade it in the same direction. So when the price reverses or retraces, as it's also called, traders look to start buying and selling in the original direction again at a better price. The Fibonacci tool is designed to help traders know exactly where they should be looking to get back into the market at a better price. The idea is that so many traders are using the same levels that it causes the exact move it's supposed to predict, kind of like a self-fulfilling prophecy. Now, of course, this concept has been massively oversimplified by educators trying to lure the impatient, inexperienced retail traders into buying their products. But the general idea does have some merit, especially when we use Fibonacci retracement levels as confirmers to the other key levels we identified. So if you want to trade bounces, you first need to identify a good level. Then you need to draw the Fibonacci retracement tool onto your chart to see if a retracement level matches up with your previous identified key level. If you get a match, then you have a confidence level and it can be traded. Pivot points are almost the exact same thing in terms of them being oversimplified by trading educators and becoming an almost self-fulfilling prophecy. The difference is in how they came to be used as a touted trading strategy in the first place. The story of pivot points began in the old exchange trading pits in the US decades ago, when the image of lots of traders wearing funny looking jackets would be crammed in a room shouting at each other. This is how trading was conducted before the advent of computers and the internet. At this time, traders didn't have charts and they didn't have access to up-to-the-minute streaming news. But they did have the advantage of seeing what all the other traders in the market were buying and selling because they were standing next to them. So each day, these traders would note the opening price on the day before and also the closing price and maybe the high and the low that the price is made. They would then do some simple calculations and come up with the prices that could be used as a very rough guide for where the price could be expected to move in the upcoming session. They then watched the market, and when the price moved close to these levels, they initiated trades based around them. Again, educators later took this concept, oversimplified it to appeal to retail traders by doing the same calculations as the pit traders and then plotting these prices onto a visual chart so that the retail traders has a really cool, easy to see level to trade each day. The problem was that when the pit traders used the levels, they also had a very deep insight into what the traders around them were doing and could not only figure out the mood of the market, but actually feel it because they were all crammed into the same room. This made these levels much more useful, but they were never designed to be a standalone trading strategy. But as with Fibonacci, they do have some merit and can be quite interesting levels to watch when used in line with solid fundamental analysis and in conjunction with previous price levels that have recently been proven by the market. The most interesting thing about pivot points, apart from the fact that they give us specific price levels to look at, is that they also give a rough guide as to where the market expects buying and selling to take place. For the sake of simplicity, let's call them buying and selling zones. So if the price is in the selling zone for that session, you can start comparing this with your fundamental analysis and any key levels that might also be in this zone to create a really solid confluence from which to trade. So now we know about those two concepts and we have a selection of key and confirmer levels. The next step is to simply look for a combination of these two types of level occurring at the same price. The more the better, because that increases the probability of a bounce happening, but 2 is enough. The next step, once we have that, is to trade them. Now the general idea is to enter with around 5 pips of the level, use a stop loss and target of around 10 to 15% of the average daily range. Remember, this is a short-term scalping. If you need help finding the daily range, then Google has many free resources and your coach will also happily help you. As with everything, the best way to become proficient with this type of opportunity is by practicing and getting continual feedback from your trading coach, and over time, by doing this, your results will definitely improve.